So in the previous video, we tried to compute the fair value of EV to sales ratio of Amore Pacific if these assumptions are correct, assuming future expected after-tax operating margin is 30%, reinvestment rate is 80%, growth rate of EBIT is 6%, and WACC to be 9% expected, then the fair market value, the efficient level EV to sales has to be 2.12. Now what? You have EV to sales ratio based on the current market cap, based on the stock price you look at, you observe, and then number of shares outstanding, and the market value of debt. Of course, book value of debt is assumed to be the same as the market value of debt because market value of debt is not really observable, not really traded openly, right? So that's that. Based on it, let's assume that you found out, current EV to sales ratio is 3.7. Then you can make a conclusion. Overvalued compared to the efficient level based on fundamentals. So your recommendation has to be sell. That's it. You remember, we have to focus on Okay, in this example, we are focusing on Amore Pacific, by the way. EV to sales ratio for consumer-related firms in Korea. EV to sales ratio, and then expected EBIT margin. Can we run a regression using scatter plot and Excel? Over here, we see positive slope, regression line, okay? And then we confirm our intuition, higher profitability, higher EV to sales ratio is confirmed. And then it's the median over there, and then where's Amore Pacific, 14.9% EBIT margin, which is about here, and then 3.7, which is about there. Okay, so is it overvalued or fairly valued, right? That would be a question. Now, EV to sales ratio, we do run a regression, and then the T statistic, significant, right? At 3% or 5% significance level. So we are happy to confirm that this is really significant relation confirmed, and then we've obtained the standard error so that we could draw on one standard error plus and minus bound, okay? And then find out where Amore Pacific is. There. We can safely, confidently say that it is overvalued, sell it. Okay? Now, that's how we do it. What happens when we use EV to sales ratio to analyze entertainment industry? Remember, I wanted to focus on the YG Entertainment in the previous example, right? So YG and then the whole bunch of entertainment companies, EV to sales ratio, and then the fundamental driver, which is EBIT margin. Okay, EBIT margin, we see positive association confirmed, but not as steep as the Amore Pacific consumer goods industry. Okay, but so let's see the regression result over here, and then we see statistical significance being only marginal. Okay, 20% level significance, but still it's positive, so reasonably okay. Considering EBIT margin, YG and Mediaplex seem overvalued. If you look at this graph, see YG being 15% margin, and then 4.64. That's this guy over here, clearly above the standard error bound, but marginally significant result. What about other drivers? So I used leverage ratio, which is debt over invested capital. Here, the leverage ratio, you can be, get some life, okay? In your I-Core project or whatever, don't get stressed up to come up with the exactly robot, precise computation of the leverage ratio all throughout. Of course, you have to be accurate, but what I'm saying is the definition of leverage. Okay, the key idea is about your default risk. Okay, so as long as some debt amount is on your numerator and then equity is in your denominator, or in this case, invested capital is in your denominator, you're fine. Okay, it reasonably captures your default risk. Okay, so it should be fine. And then this will be your horizontal axis variable, x variable, and EV to sales will be your dependent variable. Run a regression. What is our intuition? Okay, well, higher risk, lower price. Okay, because investors are risk averse. Okay, you may question, oh, the EV PB and then the analytical relation, wasn't PB ratio positively associated with leverage ratio? Okay, because high leverage ratio increases ROE. But I said one more time that the leverage ratio, superficially it looks like positively related to ROE, but the leverage ratio affects the risk more drastically, so that it increases the discount rate further, kick harder, so that the financial risk increases and then that decreases the price. So that's why we should observe negative relation between the multiple and the financial risk. Okay, higher risk, lower price. Negative association confirmed in this regression. You see this? Okay. Now, our YG entertainment, where is it? It is located over here. Okay, 19.7% debt to capital ratio, or risk level over here, and then the EV to sales ratio over there, and then this is the one standard error bound, plus and minus, based on the regression result. And here it's marginally significant, but about 11% significant level, much better than the rest of the regression results. So I have more confidence based on this regression result. And then I obtain the standard error and then make a decision based on this one. Okay, so YG seem to be overvalued. Okay, and then the overvaluation conclusion was rather common across different multiples. So it points to the same direction, even though the degree of confidence is varies and then rather weak. But notice again, YG is shown as overvalued. We have almost every reason to sell YG stocks despite the strong fundamentals of the company. For example, the intrinsic value of the company is estimated to be high, but the price is even higher than the value predicts. So sell. Okay. DCF valuation says it's overvalued. PS ratio weekly says it's overvalued. EV to sales ratio strongly says it is overvalued. So commonly I would say sell. Okay, statistical significance gives me a little more confidence to me, but that is not the whole story. The multiple is the sales multiple, which is suitable for entertainment companies that generate revenues through contacting retail customers like you and me instead of working with other B2B customers, right? So that's why sales-based multiple is also good. Is good. Good company is not necessarily a good stock. That's a very important point I want you to remember. The company has been generating high ROE and ROC over time for YG Entertainment as of 2015, but that did not mean that you have to buy the stock right now. Right now. No. Okay? It's just a good company. Okay? But that does not mean that you have to buy it. Okay, don't misunderstand. Warren Buffett's wording says when you do the valuation and then value investing, you are buying the company. Okay, not just the stock. So buy good company that has its own meaning, okay? But that does not mean that you have to buy good company all the time. Buy good company only when it is undervalued. Okay, undervalued below this confidence band over here. Okay, if it is above, sell it. Okay, or at least hold it. Okay, so that's the thing. Now, caveat, warning, be careful. Sometimes the conclusion you get from DCF valuation may be drastically different from what you get from relative valuation. For example, sell according to DCF, but buy according to relative valuation. Why? When the industry or the whole market is in bubble, your DCF valuation done correctly would tell you that you should sell the stock because the stock is overvalued. Everything is overvalued. Sell it. However, if the stock is relatively not as overvalued as their averages, your relative valuation would tell you it's below the confidence band, so buy it. Okay, so relative buy, DCF sell. What should I do? Like Hamlet. Buy the stock. This is because the relative valuation assumes that the market is efficient on average every day. You're like Hamlet, dead or alive, buy or sell. That is a problem. Now what? Okay, then what? Your decision really depends on your investment philosophy. Okay, if you are like Warren Buffett or Carl Icahn, who can wait many years, long, 3 years, 5 years, can buy and hold, and then you can kick out the management, and you can be the catalyst of change, right? You are private equity manager or venture capital kind of, right? Really affect the manager. Then DCF is your way to go. Instead, on the other hand, right, if you are a hedge fund manager, short-term investors, day-to-day, day traders, right, relative valuation is the thing you have to hold on to, okay? Who has to hold some stocks on your portfolio anyway, you should follow the recommendation based on relative valuation. In your iCore project, this kind of things may bother you. I will ask you to do DCF valuation and do the stock recommendation, and then your relative valuation, I will ask you to do it, and then your conclusion may be different from your DCF conclusion. Then choose one, okay? Don't take the average. Buy with the relative valuation and sell based on the DCF valuation. So take the average, hold. No way. Choose one. That depends on your investment philosophy, which means claim your philosophy first and be consistent with your philosophy. Okay? What kind of investors do you assume to be? Okay? Are you Warren Buffett kind of long-term investor or BlackRock kind of, asset managers or hedge funds, right? Like Renaissance Technologies or Jane Street kind of guys, right? Your predecessors are already working for Millennium Management, okay? Hedge fund or PAG or that kind of hedge funds, right? Short-term oriented. Nothing wrong with that, right? That's just one strategy in your philosophy. Be consistent. Valuing brand equity with EV to sales ratio is the last step that I want you to go through. I'm going to ask you this question in your iCore project, okay? Let's see. Why? Because we can use EV to sales ratio to value your brand equity that is directly connected to your marketing ideas, okay? So that's what I like about this. And then the textbook author, Damodaran professor, he gives a wonderful example, and I just apply it to a company in Korea, K-beauty company, Amore Pacific. Okay, in general, the value of a brand name can be written as this. Value of a brand name, okay, should be sales of the company times the difference of EV to sales ratio between your company and the company without brand equity. With brand equity, without brand equity, EV to sales ratio, that multiple may be different. Okay? So the difference of EV to sales ratio, and multiply that guy by your sales amount. Okay? After all, your brand equity is realized through selling more products to the retail clients, retail customers. So that's why we use sales multiple here. Okay? And EV to sales of B, so B means EV to for enterprise value to sales ratio with the benefit of the brand name. Okay? How about EV to sales of G? Stands for generic. What do you mean generic? No brand. Okay, no brand, no signboard. Okay, no brand equity company, generic. Okay, so let's try some exercise here. Amore Pacific's EV to sales ratio. Related information is as below. After tax operating margin is 30%, reinvestment rate 80%, growth rate of EBIT 6%, WACC 9%. Okay, so EV to sales multiple has to be 2.12. This is the same as what we did as our exercise before. Sorry for the typo here. Again, it has to be 6%, but I confirmed. Okay, as I correct the number, the result is the same, does not change. Okay, so what I do over here is that I show you the EV to sales ratio of Amore Pacific using our assumption. EV to sales of branded company 2.12. What about generic company? Okay, they cannot charge higher price because they don't have brand equity, so the profit margin will be worse. So operating margin, let's assume it to be 10%, and then the rest of the variables are the same, then the resulting number will be 0.707. Now what do? Get the difference between these two, 2.12 and then 707, and then multiply this guy by your sales amount, which is 3.87 trillion Korean won as of this fiscal year, and that gives me 5.46 trillion Korean won, and that is our estimate of brand equity of Amore Pacific. Okay, so this is how you can estimate your brand equity. Okay, there can be many different ways of estimating brand equity, but this is one way suggested by our textbook author, Professor Damodaran. Okay, we use EV to sales ratio because your industry is retail-based industry and your brand equity is realized through the sales to the customers, retail customers, EV to sales. Again, so that's the point of it. Very interesting exercise, okay? So you can play with your data, and then I hope you enjoy the rest of the semester, especially with the I-Core thing, okay? So see you in class. Bye-bye.